Welcome to the third lesson of Financial Foundations, an e-learning course brought to you by Wise Money and the financial planners here at Korhorn Financial Group. My name is Mike Bernard. I am one of the certified financial planners right here at KFG. I'm also the host of the Wise Money Show. Listen, wherever you're absorbing this content, whether it's on YouTube or online or wherever, if you found anything helpful or beneficial so far, either from the first two sessions or from today's lesson, just do me a favor and subscribe and like the content, even share the content as well. Schools, whether that's high school or college, they're not teaching wise financial habits and wise financial skills. They're not equipping you, and yet we all need these skills. All right? And so we've stepped into the gap and we're providing this e-learning course to hopefully help you get some foundational financial skills to help you on your path towards financial success. So again, if you found anything helpful, if you're going to put anything into motion, maybe even if you found anything humorous or entertaining, like the content, subscribe and share that. We appreciate it because we're trying to help people take the right next step in their financial life. Now, I've been doing this as a financial planner for the past 2 decades or so, and if you were to ask me, of all the experience that I've had helping people sell businesses and do all sorts of things financially, hey, what's the one thing, what's the one skill that you've seen transform more financial lives than anything else? It would be the 3 bank account system that Amy Masters, my colleague and friend, taught last week. So if you didn't catch last week's lesson on the 3 bank account system and the budgeting system, I know that sounds boring, like eat your vegetables, but it is that transformational. This is a skill and a habit that you're going to apply for the rest of your financial life. So if you missed that lesson, I would go back and watch it. If you watched it, I'd watch it again and then again and again until you adopt it, till you love it, because that is that important. All right, today we're going to be talking about credit and credit cards. Those are 2 separate things. Let's talk about credit first and then we'll hit on credit cards. So what is credit? Credit is your financial reputation. That's what it is. Credit is your reputation. Now, if when you hear me say that, you start thinking of high school and how some people weren't nice to you and how maybe you were mean to other people and you get all these, bad emotions, just set that aside. But I'm being serious. Your credit is your financial reputation. You know reputation. If you've got a good reputation, you've got more freedom. You maybe have some perks. Things are a little bit easier. You could get away with anything, right? If you have a bad reputation, you can't get away with anything. You don't have any of those perks. In fact, you have more scrutiny. You've got to jump over more hoops, through more hoops, if you will. Life's just a little bit harder if you have a bad reputation. But what if you don't have any reputation at all? You could have a good reputation, a bad reputation. You might have no reputation. Well, you don't get any of those perks. You don't get those freedoms. It's almost like you have a bad reputation. You've got to prove yourself. The same thing is true with credit, okay? Credit is your financial reputation. There's 2 ways that you get to peer into, well, what is my reputation? One is a credit score. The other is your credit report. I'm going to focus more on credit score and what you need to know. First of all, I'm not going to get all the way into the weeds, but a lot of times people think your credit score is your FICO score, and that's true, but there's different types of credit scores out there. The most popular one and most well-recognized one is your FICO score, and we're actually going to display some information on that right now. But just know your credit score is your credit score. And a FICO score is part of that. It's a type of credit score, okay? So, what is the range of a FICO credit score? It's a wide range, all right? So, your credit score ranges from 350 to 850. That's a big range, right? But if I can draw a line in here, right about there, 670 if that's to scale. If I could draw a line there, let's just oversimplify and say this is good, and all of this over here, that's bad. It's not good to be bad. You want to be over here, okay? And we're going to talk about how you can do that. But this is a fine line, and guess what? You're going to say life's not fair, and I'm here to tell you, yep, life is not fair, because this is actually a moving target. Depending on what's happening in the world, what's happening in the economy, this might feel like a good credit score. It might not. And you don't have complete control over that. You can influence your score. We're going to talk about that next. But right now, we're going through a recession. Arguably, they're saying this is going to be the worst economy since the Great Depression. So if you're out there trying to get a loan, banks and lenders are going to look at your credit and your credit score with more scrutiny. They're going to say, hey, 670, we used to give loans and a good interest rate based on that all the time. But now, you know what? Things are harder in the economy, and therefore you're going to need a credit score of 720 in order to get the very best rates. So just know this is a moving target. I'd probably say from 650 to 740, there's kind of a range in here where it floats back and forth between what's really good and what's not so good. So I think if you're looking online, they might call this range a fair credit score, where this is very good and down here it's poor to very bad, okay? And honestly, even though the range is this far, I mean, you get to 570 or so and below, I mean, that's poor. So it's like this end of the spectrum, you could almost cut it off. I don't even know why it goes to 350. This is really what we care about. All right? And just like with a normal reputation where you've got certain perks and certain freedoms and so on, if you have a good credit score, guess what? You get perks, you get freedom. You're able to borrow more money to maybe buy your house, so you could get a bigger house. You could maybe borrow more money to get a car, therefore you could get a nicer car. You'll get a lower interest rate on that house. Therefore, that house will be cheaper for you if you have a low or a good credit score. Think about that. Yet that car will be cheaper for you because you'll get a lower interest rate. You could get better perks and different points from your credit cards, which we'll talk about next, if you have a good score. And get this, your life insurance could be cheaper. Your home and auto insurance could be cheaper. Your car or your cell phone bill could be cheaper. Life is easier for you if you have a good credit score. You might say, well, that's not fair. That's profiling. That's even discrimination or whatever. No, it's based on, do you have a good reputation? If you have a good reputation, financial institutions can trust you more, and therefore you'll get more perks. Life's easier for you if you have a good credit score. It's harder for you if you have a bad credit score. You have to pay higher interest rates, meaning that house that you wanted to buy is now going to cost you more. Maybe you won't even get that much loan and you need to buy a smaller house, or not as nice of a car, or not as good of a cell phone plan, or your life insurance might cost more, your car insurance might cost more. So the folks that have, it's easier. The folks that are have-nots, life is harder. So therefore, if you could pick what your financial reputation was going to be, I'd want you to pick on the good side, right? So how do you do that? And we're going to talk about some foundational things in the action steps in a little bit. But so how do you do that? What goes into your credit score? Well, this is where we're going to focus in on the FICO score and the FICO mentality. There's 5 different items here, factors that go into your credit score. We're actually going to show that here on the screen while I talk through it. So the first of all is your payment history. Okay, your payment history makes up the most part of what your credit score actually is. So making payments on time makes up the largest portion of what your credit score is, whether it's good, fair, or bad. And yet right now, we even had politicians saying, the economy is bad, you might be unemployed, don't pay your mortgage. That is insane. That is insane. If they knew, or if you knew how much of your credit score was relying on you paying your full amount on time, you would never miss a payment. So payment history. Second, amounts owed. There's a lot that goes in here, but how much of your credit limit do you have borrowed? So amounts owed is the second. Third, length of your credit history. So just like trust, your reputation is built slowly over time. Therefore, the more good credit history you have, the longer you have a history, the better your score tends to be. Fourth, your mix of credit, or the types of credit that you have. So is it all retail, where it's JCPenney, oh, not that anymore, or Pier 1 Imports, no, you don't have that anymore either. Or a Target credit card, how about that? Or some other type of credit card from a retailer, or is it a mortgage or a student loan? So the type of credit that you have actually impacts your credit score. And then lastly, new credit. So requesting a lot of credit, so applying for a lot of credit cards at one time, can actually influence your credit score in a bad way. Basically, the idea is if you need credit, if you are needing a lot of credit and you're applying for a lot of credit cards, that's basically a bad sign that, hey, there's a problem and I need money. And that's sort of tipping your hand to these credit card companies that, nope, we don't want to lend to you. We don't want to extend credit to you. So the more new accounts you're trying to open, that has a big impact on your credit score as well. So if I were to assign one action item, it'd be, well, be very, very aware and cognizant of those 5 things. All right, what else would I tell you to do? Again, going back to your financial reputation, one of the ways that you can lean in and peer into your financial reputation is looking at your credit score. But the other thing that you can do to look at your financial reputation is look at your credit report. One of the things I would tell you to do is check your credit report once a year. You can do so at annualcreditreport.com. This is not an endorsement, but that's the site that I use once a year. You can go to that site, log in, put in your information, and you can actually download your credit report from each of the 3 agencies. Now, is your credit report the same thing as your credit score? No, we already covered that. Those are 2 separate things. Your credit report is actually telling you, it's a report that shows all of the outstanding credit that you have. You've got a mortgage with this balance, your payment history has been this. You've got a credit card with this company, your payment history has been this. You've got a car loan with this company, your payment history has been this. So you're going to want to download and look at that report once a year, because sometimes you can get blamed for someone else. Have you ever had your reputation influenced by that bad kid in school that sat next to you in class? They did something and the teacher turns around, looks at you, and they point to you like, oh, he did it. That can happen with your credit report too. Someone else's information. Does someone have a similar name as you? Has there been identity theft? A bunch of bogus stuff could show up on your credit report and start influencing your credit score. That's why you need to look at your credit report at least annually to make sure that nothing fishy is going on. If you've got old cards that you don't even use anymore, clean that stuff up. If there's a misspelling, clean that up. If other information is on there that shouldn't be there, clean that up. The next thing that I would tell you is, well, if you're careful about your payment history, you're careful about how much new credit you have, all those 5 factors that go into your credit score, well, how do I actually build credit? And if this is an e-learning course on financial foundations, how do I actually get started building credit? That's the second thing. The number one way that people build credit, people use credit, and people destroy credit is credit cards. That's what we're going to talk about right now. If I were to give you an analogy of what credit is and actually credit cards, I would tell you it's like fire. When it's used responsibly, it can cook your meals and it can heat your house. But if it's used irresponsibly, or even if you have one lapse in judgment, it could burn your house down or it could kill you. And I know that sounds extreme, but there are people that have played with that financial fire, that credit card, and they've gotten burned and their financial life is in ruins. They've had to build it up. It's as if it went up in ashes. So be very careful when it comes to credit. Now, a couple things with credit cards. Let me just get rid of my terrible drawing here. When it comes to credit cards, basically a credit card is a short-term loan. you're borrowing money for the short term, okay? You know, if you've got cash in your wallet, no one has that anymore, or you're using your debit card, as soon as you swipe that debit card, money comes out of your checking account. Money is spent. You had this much in your checking account, now you have this. But when you use a credit card, you're using someone else's money. Your checking account balance is the exact same. You are borrowing short-term IOU from someone else to make that purchase. Now, if you're borrowing someone else's money, they're going to charge you for using it. So they're going to charge an interest rate for using their money. What's that interest rate? Well, I did a little research to see what the average was. And the good news is the average credit card interest rate has gone down recently, basically because of this economy. So it's only 16% as an interest rate. Here's an example. Here's another average. The average balance right now for Americans, their average credit card balance is around $5,700. And you would say, well, that's not that bad. But you know, a lot of people don't carry a credit card balance. They don't have any outstanding loans that they owe someone. And so if you remove those people that have no credit card balance and just look, if you have a credit card balance, what's the average? The average balance is $9,000. So if you do the math, I'm not going to do it right here, but that's a payment of $120 a month just to pay the interest. That is excessive, especially thinking that interest rates, if you're a borrower, if you're borrowing money, you owe interest. This goes back to the habits video. You owe interest if you're borrowing money. But if you have money sitting in your savings account, then you're earning interest. Right now, the average interest rate on a savings account you need to have $160,000 sitting in the average savings account, earning that to just offset what the cost would be if you owed $1,000 to a credit card company over the year. No wonder they offer so many perks. No wonder they offer so many perks. We'll give you, 1% cash back if you charge this stuff. We'll give you points for this and airline miles and all sorts of stuff. No wonder, because they want to give you an incentive to use their card and swipe it when you go to the grocery store or use it when you pay online at Amazon or whatever. Because if you get hooked, if you happen to be one of the folks that carries an average balance and you get hooked, any incentive they can offer is worth it. If you're addicted to that credit, you're going to be paying a significant amount of cost over each year and over your lifetime compared to what you could get as a lender yourself. So don't get hooked. All right. So what else with credit cards here? If you're trying to build credit, I typically recommend that someone start with a low balance credit card. And just like Amy talked about in the 3 bank account system and the budget discussion last week, I would use your credit card to just buy something that already fits in your budget every single month. Make one transaction every single month that already fits in your budget. And then when you get the bill, pay it off completely. There's no interest if you charge something and pay it off completely by the time you get the bill within that first month. So using credit, how I built credit was I used my credit card every time I went and put gas in my car. Every time. Now, it was in my budget, so I knew I was never going to overspend, but every time, instead of using debit card or cash back in the day, because I'm old, I would use my credit card. And then once a month, I'd get that bill and I'd pay it off completely. And my credit score went from basically nothing. I had no reputation. I started with a Discover card. That's not a recommendation either. And I built up from basically no credit score up to about 800. just simply by doing that. Not charging all sorts of stuff and borrowing all sorts of money and trying to pay it off. That's not how you do it. It's just consistently showing, I'll use credit and I'll pay it off. I'll use credit and I'll pay it off. I'll use credit and I'll pay it off, okay? That allows you, so that system, that habit built into the 3 bank account system allows you to build credit from the ground up without really playing with fire. Okay? So a credit card is just a short-term loan. Do you need lots of credit cards? No. I only use one. I think I have 3 of them. To me, if it's playing with fire, I have no idea. I don't want to get burned. So do you have to go after ones with high points and so on? Only after you build credit and have those habits in your life can you go after ones that have high points and high limits and all that sort of stuff. When you're trying to build a financial foundation, you just need to get in the habit of only charging what's already in your budget, what you have the cash to pay off, and then paying it off in full every single month. All right. I hope that discussion on credit and credit cards is helpful. Let's get to next steps. First, as I already talked about, build credit. So, where can you go get your very first credit card if you don't have one already? The first place I would check is probably your bank or credit union. One of the ways that you can show credit is that you've got an actual bank account, a bank account, checking, savings, and maybe you have direct deposit going in there. So oftentimes your bank or credit union will be the first ones to say, hey, here's your first credit card. It's got a $1,000 limit on it, so you can't go too crazy, or a $500 limit, something like that. The interest rate's probably going to be higher than that 16%, again, because you have no credit, but that's a good place to start. My first one was with Discover, but that was 20 some years ago. I think right now Capital One offers an introductory credit card. So I would check into those and I would get in the habit. So get a low balance, or a low limit, meaning you can't charge a lot, credit card, and get in a habit of charging something and then paying it off completely at the end of the month. So I would start that if you're trying to build credit. Number 2, I would build the right habits. So that's exactly, pick whether it's the filling up your gas tank, or paying for Netflix, or paying for Disney Plus, or the gym membership, you can't go to gyms, or whatever, right? Pick something that is just going to show up in your budget each and every month and say, that's the only thing I'm using this credit card for. Maybe you don't even put it in your wallet. You just use it for an online purchase or an automatic purchase every month. You don't even put it in your wallet. You just build the habit of charging a little bit, paying it off, charging a little bit, paying it off. And that leads us to the third action item, 3 bank account system. The 3 bank account system is the credit card avoidance system. You will never have a credit card problem if you have a budget that manages all your immediate spending, a delayed spending account where you're saving up for and paying with cash all known upcoming expenses, and an emergency fund where you've set money aside just in case an emergency or whenever an emergency comes up. And then you've got credit cards on the side just in case, and you're building credit. You'll never have a credit card problem if that's the system you use. So oftentimes, if people come into our office and say, listen, I made some financial mistakes, I need some help. One of the first things we're doing is getting them set up on a 3 bank account system. An ounce of prevention is worth a what of cure? That's the way. Just get started with the 3 bank account system, using a credit card to build credit along the way. And that leads me to the 4th action item is, if you're listening to this and you say, listen, I have gotten started on the wrong track financially. I've made some mistakes with credit. I've gotten burned. This is a humbling moment. You know how many people listen to Dave Ramsey and are now millionaires after filing bankruptcy because they've seen the light and they're like, nope, I've seen the pain that this can cause. It's time to get serious and make great progress in my financial life and avoid credit cards. If that's you need to rebuild. You got to talk to a financial coach and probably work on a debt snowball in connection to a 3 bank account system. Okay, if that doesn't make sense, we're going to be hitting debt in just a couple of weeks, so stay tuned for that. But you'll want to sit down with a coach where they can help you build out a budget and build out that 3 bank account system, and then figure out what type of debt snowball can work. Don't run to debt consolidation, or don't make any extreme measures, and certainly don't just avoid making payments, because we already said that makes the biggest impact on your credit score, which will influence all other sorts of, it'll have a lot of other trade-offs because it's your financial reputation. So those are action items. Start building credit, okay? Have the right habit as you're using your credit. Put it in the process with a 3 bank account system. And if you've made some financial mistakes and need to rebuild credit, contact a coach and get started on that process. I don't know how we can talk about foundational financial principles without talking to you about the benefits and dangers of credit. Hopefully today you've heard a little bit about what your credit is, how to have a good reputation, a good credit score, what the factors are, and how that can benefit you financially, and then how to use credit cards in a responsible way so that it helps your financial reputation. Leave comments below if you have any questions. This is one that a lot of young people, as you're getting started financially, it's just confusing. Interest rates and borrowing money, it just can be a little confusing. Reach out to our team if you have any questions or need any help. You can find us online, corehorn.com. That's Corehorn with K, or right here, Wise Money as well, wisemoneyshow.com. All right, hey, this one was sort of a negative one. If we're talking about financial foundational principles, you got to talk about credit. But what's the dessert? The dessert is next week. One of the best teachers that I've ever met in my life is Joshua Gregory. Proud to call him a friend and a colleague. He's going to talk to you about investing. That's so fun. And then I'm going to wrap up our eLearning Financial Foundations course on debt in 2 weeks. So stay tuned for that. Make sure you're back here next Wednesday at 10 a.m. Again, like, subscribe, and leave comments below. Thank you very much.